Hello everybody and welcome back to another installment from our series Straight from the Horse's Mouth. Today's webinar focuses on how the European Commission is creating a set of rules that will, over time, bring sustainability reporting on par with financial reporting. This includes reporting on climate-related financial risks and benchmarking one's operations to the EU taxonomy of sustainable economic activities. Here's a sneak preview.
In this case, it's not the risk that we expose all of us to by not reducing emissions, but it is the climate change risk on the business.
Europe's Man on the Moon moment is our decision to become the first climate neutral continent by 2050, and that requires a lot of finance. 800 billion New Zealand dollars worth every year between now and 2050. This sends a very clear signal to businesses worldwide that business as usual is not possible anymore. In Germany, some key industries were not able to move their goods last summer because there was not enough water on the River Rhine. So that is, one of the impacts of climate change already hitting companies now.
The EU's major influence on global standards and its role as a significant market player means its reach extends to New Zealand and Australia. This direct and indirect impact globally is dubbed as the Brussels effect. With that, let's get started.
Good afternoon, everyone. Welcome to another webinar in our series Straight from the Horse's Mouth, Insights from Experts in 30 Minutes. Our topic today is about the EU, TCFD, and the trade, exploring the Brussels effect. And we have Caroline Lambert, the head of trade of the European delegation to New Zealand, with us as our guest speaker. And I'm really delighted to have Carolina here, because who else could tell us about what's happening in Europe and how it would have an impact on businesses down here in New Zealand and in Australia. Before I hand over to Carolina, I will just give a very brief few ideas on setting the scene on why do we think that sustainable finance reporting, the EU and TCFD are actually relevant for trade. And all those reporting frameworks and the requirements on sustainable and financial reporting, to me, are actually a translation tool. They're about connecting two tribes, sustainability and finance, because they really do speak very different languages. The sustainability people amongst us are fluent in emissions, green water, carbon, geothermal energy, renewable. All those words come naturally to us, and we could report on them every day. But then there is the business side of all the businesses. They understand customers, market demand, partnerships, corporations, profit, property. So there's not a lot of overlap. And when it comes to reporting, that is where those two tribes meet, and where good sustainability reporting actually helps to translate. And that is not something just related to the EU. It's already happening a lot in New Zealand and in Australia. And really, the business community has taken it on. So if we look at the definition of sustainability from the UN Global Compact, more a sustainability-focused group, if you like, corporate sustainability is a company's delivery of long-term value in financial, environmental, and ethical terms. Even there, the word financial creeps in. If we look at the other side, the Dow Jones Sustainability Index, you couldn't be more financially focused than the Dow Jones, says corporate sustainability is a business approach that creates long-term shareholder value by embracing opportunities and managing risks deriving from economic, environmental, and social developments. It really is coming together everywhere. The New Zealand Stock Exchange has a recommendation that businesses do need to report on elements that a socially conscious business needs to measure. Their environmental criteria, social criteria, governance, and the exact same is true in Australia for the ASX. A listed company should disclose whether they have material exposure to economic, environmental, social sustainability risks. And here the word risks comes up again. The TCFD that a lot of you would have heard about is the Task Force for Climate-Related Financial Disclosure. And that is all about risk. It's about the risk for businesses. In this case, it's not the risk that we expose all of us to by not reducing emissions, but it is the climate change risk on the business. What does it mean for us as a business that climate change is happening? Are there any physical risks? Like, have we built in the floodplains of a river and therefore have a risk? Is our business model possibly not fit for future because we might have to reduce our emissions so that we can't run the business as we used to? So those are all the risks that we need to be aware of and that we need to report under TCFD. And New Zealand actually has even made that mandatory. And we will hear from Caroline on what it means from the EU, what their regulation means for the reporting of businesses down here. And with that, I'll hand over to Carolina. Thank you so much again for joining us today. And I'm very much looking forward to hearing from you.
So I'll talk about what Europe's man on the moon moment may mean for New Zealand with regard to sustainable finance. Europe's man on the moon moment is our decision to become the first climate neutral continent by 2050, and that requires a lot of finance, a lot of sustainable finance, actually 800 billion New Zealand dollars worth every year between now and 2050. It's so much so that it's not possible to do through public money, and we have to have private investments also chipping in and helping us through that transition. So our sustainable finance strategy is our way to make this happen for us. That it also takes place in a global context for finance that applies to New Zealand as well. The legal context is that we now have a universal legally binding agreement with more than 195 countries saying we want to go to net zero before or soon after 2050. This sends a very clear signal to businesses worldwide that business as usual is not possible anymore. And litigation, climate litigation, has started to be quite a risk for national governments, but also for businesses in several jurisdictions of the world. The scientific context is that on the 9th of August, the International Climate Sciences Group, independent group, the IPCC, told us that we have only 9 years to reduce our emissions by close to half, so that we can keep things under control and avoid the worst effects of climate change. The IPCC also told us that the impacts are not for tomorrow, they're already now, and they are pervasive in many ways throughout the economy. In the European Union, in Germany, some key industries were not able to move their goods last summer because there was not enough water on the River Rhine. So that is, one of the impacts of climate change already hitting companies now. Policy context is that across the world, governments are taking action and legislating, regulating things like carbon prices, ETSs, phase out of fossil fuel technologies. In the European Union, the internal combustion engine will not be of use anymore or on EU roads after 2035. Carbon footprinting requirement for products are also coming in through legislation. So the investment context, of course, changes, and climate change is both a risk and an opportunity for the financial sector that the sector needs to navigate wherever the sector invests throughout the world. The consequences is that there is currently a booming demand for investors for what they call Paris-aligned investment products and projects. Banks and corporates are committing to redirect their activities towards less carbon-intensive activities worldwide, because this just makes good business sense for the financial sector. It's less risky. It's aligned with a vision for the future that is supported by 195 countries. However, there's problems of scale. There is both not enough commitment, not enough finance flowing towards transition action towards climate action to meet the net zero goal in time. And there is not enough green bankable projects too. So there's also finance in search of an outlet for a green financial product for those who want to invest. And there's a risk of greenwashing because there's not a unified definition of what is a sustainable economic activity at the moment. So what we see is growing international rivalry as to what the effects of the global allocation of capital will be when regulatory reforms about sustainable finance, about financial markets, banks are taking place. So it's a place of cooperation and of tension and competition. And the European Union has taken the lead by creating what is called the International Platform on Sustainable Finance. New Zealand has joined the platform, so has Canada, the US, Japan, China, big players, so that we can discuss together some key main elements of key main pillars of sustainable finance, and I'll go through them now. The first is defining green, defining what is a sustainable activity. There's two main ways that jurisdictions are going about it. Either define in law, this is a sustainable activity, hence any investment in that activity can be called green finance, sustainable finance, or some are using private standards. The second key discussion is around disclosures, climate-related disclosures. This was launched by the TCFD, a G20 group, the Task Force on Climate-Related Financial Disclosures, so that there would be a vision within the G20 about what banks and financiers needed to have in mind with regard to climate-related risk. This promotes financial stability. It helps price risk internationally and ensure that we have the right information, that investors have the right information about what is a sustainable, less risky investment from the climate perspective. But the scope of disclosures varies internationally from only the financial sector to financial sector and corporates. In New Zealand and in the European Union, the second option has been chosen. That is, both financial sector and corporates will now have to report on their climate-related risks. I'll go more in detail soon. The third type of discussion is about reporting. Not only the reporting about the risks that you're exposed to, but reporting as to the impacts of your activities on the environment. This is also now changing discussions around accounting. And here the crucial issue of materiality is at the heart of the international discussions, whether we should only look at the materiality of the risk, environmental risk on the business, or the impact of the business on the environment, and how, in fact, there's a feeding loop between the two issues. And whether we should ask corporates to just report on the situation today, but also about what their plans are for the future and how they see the risks going forward into the future. In the European Union, we went for a holistic framework, and we're not shy about arguing that it's the best way forward and trying to explain it to our international partners. The first thing we did is that we took the approach of defining what a green activity is. It's a legislation, it's what is called the taxonomy. And there's not only the EU taxonomy around, China is developing its own taxonomy, Japan is developing its taxonomy. In New Zealand, there is a discussion about taxonomy as part of the Outer Circle, the Sustainable Finance Center. So taxonomy is a new word that one needs to get to. The second thing that we've done is to also agree a compulsory disclosure and reporting framework for all companies, be they financial or not. And that reporting has to be done according to the classification, according to the taxonomy. So while New Zealand has finalized the legislation of its framework, there's been only 3 readings and it's already in place for 2023. In the European Union, we also tabled the legislation to make it compulsory, but legislation in the EU takes a bit more time. You've got 27 member states that need to agree, but our compulsory disclosure will in fact kick in at the same time as New Zealand for 2023 as well. We've also developed rules for green bonds, for green eco labels, for financial products, etc., that use the taxonomy. How does this work? It all is based on the definition of green. And I'll go in more detail about how we went about defining what is green economic activity. And then the definition of green is used by our disclosure framework, whereby already since March this year, every financial actor in the European Union that provides a new insurance product, a new pension product, or a new investment product, and says, well, this is a green product, this is a sustainable product, well, that financial institution, that financial sector has to explain in what sense it is green. Is it really aligned with the EU taxonomy? So there's already a provision for the financial sector to explain about their so-called green financial products. What Swiftable recently is this reporting directive that covers both risk and reporting, and I'll talk about it, and that will kick in also in 2023. And we've also made a new rule that when, as a retail investor or someone that wants to know what to do with one's savings or wants to buy a new retirement pension product or insurance product, the first thing that the financial sector has to ask you as a customer is, what is your opinion about sustainability? What type of product do you want to be offered? So it's a new compulsory question, which we hope will help ensure that people's views about the world and these issues can be better reflected in their financial choices. And then we're setting up a series of tools like the green bonds, for which all proceeds from green bonds will be used for taxonomy aligned activities. Very useful in a recovery framework, but there's lots of green stimulus that we want to be green, but it's difficult to ensure that it's all green, the public money that is being injected. And the green bond framework allows public and private enterprises wanting to do this to make sure that they are not greenwashing at all with their efforts. So how did we define green? We have created some sort of a dictionary that explains for every possible economic activity what kind of metrics, what kind of thresholds these businesses have to reach to be labeled as green, either as an equity or in terms of when they're asking for a loan, whether that loan to that company can then be a green loan, green finance. So the definition of green is based on 4 conditions. As a business, as an economic activity, to be green, you need to provide substantial contribution to one of 6 objectives, environmental objectives, and there is a choice. There's several ways in which you can be green. You can be green because you're very efficient from the carbon emissions perspective. That's the climate mitigation objective. You can be green because you're helping protect biodiversity. That is the number 6 objective. So we came with these 6 objectives, but it's not enough to provide a strong contribution to any of the 6. You have to do no significant harm to any of the other 5. This is to avoid that there are trade-offs between different types of environmental objectives, and then some economic activities can do very well in terms of net zero emissions, but do very badly in terms of water quality, for example. So that definition of green avoids that only one metric of green is used throughout the economy. The third condition is to comply with minimum social safeguards, and then come the technical screening criteria, the actual thresholds, quantitative thresholds mostly. The way the thresholds work is that for any activity, there's 12 thresholds, so 2 thresholds for each environmental objectives. And I'll take the example of climate mitigation, so reducing emissions. As a company, let's say you are producing electricity. If you already produce 0 emissions from electricity, you're clearly in the green zone because you're above the substantial contribution threshold, which in the current EU legislation for electricity generation is 100 grams CO2 per megawatt hour. So if you produce less than 100 CO2 per megawatt hour as you go about your activity of generating electricity, you will be in a green zone, provided you are not harming, and so you meet the metrics, the do no significant harm metrics for all the other environmental objectives. So companies can very clearly see themselves either in the green zone or in the middle, in the gray zone, or in the brown zone for any of their economic activities now. What we have covered at the moment with our taxonomy, so the definition of green, is what corresponds to about 80% of CO2 emissions in the European Union. We've finalized the metrics for electricity generation, for transport, for forestry, for buildings, for ICT activities, for manufacturing. But what we have not done yet, but we will table the metrics in December, is agriculture and energy other than power. That's because it's very difficult. It was very difficult to agree on the metrics for these activities, and we needed a bit more time and a bit more science to come to an agreement. The way it works is that a company can have several activities. I don't know, you can produce glass, aluminium, electricity, and do I don't know, whatever, some sort of chemical company. Well, you will have in the European framework to benchmark your 4 activities vis-a-vis the taxonomy and say how much of your turnover is green. And you will also have to report on your OPEX and your CAPEX and say how percentage is also green. Over years, the idea is that banks will be very interested in lending you transition finance to go from the gray zone into the green zone, or from the brown zone into the gray zone, etc., so that we transition step by step through finance that can then be called green, sustainable finance, the economy and economic activities on the territory and beyond in the sustainability zone. We're using the taxonomy across the whole financial value chain through different tools. Retail investors now, as I explained, will have the opportunity to express their preferences when they're meeting with their advisors. Investors have to disclose if their investments are in a green zone or not. Labels will now very clearly indicate whether the proposed financial product is green or not. Companies will have to disclose, and EU public finance, we also, member states and budgets, we also soon, within a couple of years, also have to explain whether the way taxpayers' money is spent is compatible, is linked to the taxonomy. For reporting, we're using a double materiality threshold that is that's broader than the TCFD. The TCFD really focuses on the traditional financial materiality approach that you can see at the bottom of that slide, where it's the impact of the environment onto the real economy that is disclosed, that needs to be disclosed. What we're adding in our framework is the impact of real economy, of economic activities on people and the planet. And all of that is transparent information that goes to investors and financial institutions. The reporting framework covers, as I explained, these 6 environmental objectives and completely mirrors the EU taxonomy, covers social issues, and covers all sorts of governance issues regarding how the company operates. The legislation is called the Corporate Sustainability Reporting Directive. What's really interesting is that it's not going to be a new glossy CSR report anymore. It will be integrated in the legally required management financial report every year, and it will be audited. Until we develop the reasonable assurance standard, it's going to be limited assurance. And once we have these standards, then it will have to be audited. The format of reporting will be digital, and it will be enforced, and there will be sanctions for those who do not give the information or give misleading or false information. So what does it mean for New Zealand? Already from next year, big banks, so EU financial market participants, let's say Rabobank, that's quite active here, and other banks and pension funds that are looking for long-term investments in New Zealand. Who could that be? Insurance companies looking for investment in forestry. All these big institutional investors will need to report on their underlying activities they finance, wherever the underlying activities are in the globe. they'll have to report whether these activities are aligned with the taxonomy. So that will cover any investment done by European banks in New Zealand, but also insurance companies, pension funds, the financiers. From 2023, this will be expanded to corporates. They will have, so that's all EU listed companies, but also non-listed companies, as long as they have over 250 employees on the EU territory. But then again, the extraterritorial impact is mostly that they said that there is a broad, in fact, will also be covered as long as they have enough employees or are listed on the EU market. Because yes, it's wherever activities take place. And what will need to be disclosed is the proportion of turnover, OPEX and CAPEX that is taxonomy aligned. So the percentage of your activities that are in the green zone. And what is your plan to get more of your activities in the green zone? What are your investment plans? So what are we doing internationally on this? We're trying to lead by example. Do not need to dwell on this. We're using diplomacy, trade, and development cooperation as well. So, and I mentioned that this will now start applying to finance the private funding, public funding as well. It means that we will look at using the taxonomy for our development funds abroad and for all of our support mechanisms. We're also discussing so internationally, and the most, I think, exciting discussion that we have is on a common ground taxonomy that we are developing together with China to look at what is the definition of green that we have in common across jurisdictions, to make it easier for multinationals and companies that operate across borders to be able to report in different jurisdictions using similar metrics. We are, of course, negotiating a free trade agreement with New Zealand at the moment that will mean that we have more trade, exchange of goods and services and investment. And that will increase the possibility that our two jurisdictions' visions of green and reporting be more in conversation in the future. And hence, thank you, Barbara, for the opportunity to explain our system. Thank you.
Oh, I cannot thank you enough. That was really interesting. And it's so good to hear straight from you what the EU is doing. And it's not staying in the EU. It has an impact on all businesses in Australia and in New Zealand. And I have to say, not only a big thank you to you, Carolina, for sharing it with us, but actually a big thank you to the EU for doing all the hard work, because it will filter down and will hopefully improve reporting everywhere. And by setting up the taxonomy and the framework, it means it's so easy to adopt it for others. And why do anything less? There is a question from Phil. If a company is promoting green aluminium, green steel, green cement, then in the EU, would this be captured and required under the taxonomy?
So then we need to see how big the company is, if the company is caught within the reporting system. But usually if you produce aluminum, steel, or cement, you're a big company. So yes, you would need to, in your annual report, financial report, explain whether you meet the green threshold of the taxonomy for the production of aluminium, which is quite ambitious, of steel and cement. We've already developed the metrics for that one. What we're doing, and that's maybe where the question is going at, is we're also going to propose table legislation within 3 weeks on false green claims. At the moment, there's not easy enforcement against false green claims in the European Union, because we have to go case by case, whereas we are trying to set up a system whereby every green claim put on the EU market by any company that, headquartered anywhere, would have to be substantiated towards a common benchmark. And indeed, the common benchmark that we're thinking of is actually using the taxonomy metric.
Thanks again to all of you for joining us today. We do have another webinar coming up on science-based targets. And I'll just use that now to remind everyone there is a new standard coming out tonight from the Science Based Target Initiative about net zero standards. What does net zero really mean? Because net zero cannot just be offsetting, but we'll have more on that very soon. So thanks again, Carolina, and I will see you all next time, and I wish you a wonderful afternoon.
Kia ora. Thank you.
Thank you very
Bye-bye.
much. Goodbye.